Welcome to the Finance Function section. In this section, you will learn how to use Excel to make financial decisions and analyze investments more effectively. We'll start with important functions like NPV and IRR, which help you evaluate the profitability of projects and investments. Then we will move to XNPV and XIRR, which are more advanced and accurate versions, especially useful when cash flows occur on different dates. You will also learn PMT function, which helps you calculate loan installments, and functions like rate and NPER, which are essential for understanding interest rates and loan durations. These functions are widely used in finance, valuation, loan analysis, and business decision making. By the end of this section, you will be able to confidently analyze financial scenarios and make better data driven decisions. Don't forget to download the file on Finance Function for practicing along with me. Let's get started.
Excel is the backbone of finance, valuation, and investment analysis. In this video, we will discuss the most important finance functions in Excel. The first function to discuss is the NPV or the net present value. Net present value is used to calculate the present value of a series of future cash flows by discounting them at the required rate of return of the investor. So here we will look at two examples. In the first example, we have a series of cash flows from year 1 to year 4. So in the first 2 years, the cash flows are negative, and in year 3 and year 4, the cash flows are positive. The discount rate for calculating the net present value is 14%. So we want to see whether this project is value creating or value destroying. Whenever we use NPV or net present value to assess a project having a net present value greater than 0 is value creating, whereas if the project's NPV is negative, it means that the project is generating returns less than the discount rate or the required rate of return, and hence the project is value destroying. To use the NPV function, we will type is equal to NPV bracket open. The first input required is the rate, which is the discount rate. In our example, the discount rate is 14%. So we'll link it to cell D9, put a comma. The second input required is value. So it is asking for value 1. So there has to be minimum one value to calculate the NPV. And then there could be a series of values. So value 2, value 3, and so on and so forth. Here we have four cash flows. So we will select all the cash flows and close the bracket and enter. So we see that the NPV of this project is 1286.66. It is a positive value, and hence the project is value creating. Let us look at another example. So here we are assessing an investment. The initial investment required is $100,000, and then from year 1 to year 3, this investment will yield 30,000, 50,000, and 60,000 to the investor. The discount rate is 12%. So let's see how we use the NPV function over here. To use the NPV function, we will type is equal to NPV bracket open. The rate is 12%, comma. Now the question is whether we should select all the four values over here. So one thing to remember in Excel's NPV function, it assumes that all the cash flows occur at the end of each period. Therefore, the initial investment made, which occurs at the time 0, must be added separately. So since this formula assumes that all the cash flows are occurring at the end of the year, we will select the cash flows from year 1 to year 3, close the bracket, and then add the initial cash flows separately, which is a cash outflow, and press enter. This is how we can use the NPV function to evaluate a project or an investment. Let us look at another most used function in Excel, which is the IRR. IRR is the internal rate of return or rate of return generated by an investment. It is the rate at which the net present value of an investment is zero. That means that the present value of cash inflows and present value of cash outflows are equal. So we have a similar example where we have the initial investment of $100,000 and then cash flows from year 1 to year 3. To use the IRR function, so we'll type is equal to IRR bracket open. There are two inputs required. The first input is the values from a project, and the second input is a guess. So what is the guess for the IRR, which is optional. So to use the IRR function, we'll type is equal to IRR bracket open and then select all the cash flows from the project, close the bracket and enter. So the IRR for this project is 17%, which is more than the discount rate of 12%. So that means that the project is value creating. Let us see how it is compared to the NPV. So if we calculate the NPV for this investment, we'll type is equal to NPV. The first input, which is the rate, so we'll select the rate, comma, select all the values excluding the initial investment, close the bracket, and then add the initial investment separately like we did in our previous example. So NPV is 9352 for this project. So by definition, IRR is the rate of return at which NPV from a project is equal to zero, meaning that cash inflows from a project is equal to cash outflows. If we change the rate of return required from the project equal to 17%, which is the IRR, the NPV should be zero. So let us see if it works. I'll just change the required rate of return, the first input for NPV, from 12% to 17%, and then click enter. So we see that NPV of the project is zero at 17%. The IRR from this project is 17%, whereas the required rate of return is 12%. That means that the investment is value creating, and any investor which invests in this project will have a positive return. Let's look at another function in Excel, which is XIRR. IRR can be used when there is an initial cash outflow and then cash inflows. It cannot be used when the cash flows are irregular. So XIRR function in Excel helps us solve this problem. In real life, cash flows are often irregular and do not occur at equal time intervals. In such cases, the IRR function does not give accurate results. XIRR solves this problem by using the actual dates of cash flows, making it much more accurate for real world investment. Let us look at an example on how we can use the XIRR function. Here is an investor who has invested $10,000 every month from 1st December 2024 to 1st December 2025 in a mutual fund. So $10,000 are invested every month in a mutual fund, and on 31st December 2025 the value of the mutual fund is $140,000. So now the investor wants to calculate the rate of return generated by his investment. In such a situation, we cannot use the IRR function in Excel because the cash flows are irregular at different time periods. These are not annualized cash flows, these are at a specific date. So, here in such a case, we can use the XIRR function in Excel. To use the XIRR function, we'll type is equal to XIRR bracket open. So there are two inputs required to use the XIRR function. One is the value and second is the dates. So we have the values from cell C4 to C17, and the dates of these investments and values are in column B, B4 to B17. The third input, which is the Guess of the IRR is optional, so we will leave it blank, close the bracket and enter. So the XIRR or the rate of return from the investment is 13.4%. So somebody who has invested $10,000 every month from 1st December 2024 to 1st December 2025. So the total value of the investment is $130,000, but the value of the investment on 31st December 2025 is 140,000. So that means that these monthly investments have generated a return of 13.4% for the investor.
When working with financial models, timing is everything. Cash flows don't always happen at regular intervals, and that's where Excel's XNPV function becomes powerful. XNPV stands for Extended Net Present Value. Unlike the regular NPV function, which assumes cash flows happen at equal intervals, XNPV calculates the present value of cash flows based on the actual dates. That means it's more accurate for real world financial analysis. Let's understand the syntax first. XNPV needs three inputs. Rate is the discount rate or expected rate of return of the investor. Values is series of cash flows, and dates is corresponding dates for each cash flow. Let's look at an example to understand how XNPV works. Let's say we invested $10,000 on 1st January 2024 and then receive returns at irregular dates. Let's assume that the discount rate is 10%. To calculate the XNPV, we will type is equal to XNPV, bracket open. The first input is the rate or the discount rate, comma, values is the stream of cash flows, and the third input is the dates corresponding to the stream of cash flows. Close the bracket and enter. Here we get the XNPV of $1,271. This means that the net present value of these cash flows considering the exact timing is $1,271. Since it's positive, this investment is financially worthwhile based on a 10% return expectation. If we use the regular NPV function over here, it would assume that the cash flows will occur at the end of each year, and that would give a less accurate result. If we use the regular NPV function over here, it assumes that the cash flows occur at the end of each year and would give us an inaccurate result. XNPV solves that problem by factoring in the real dates. Thank you.
Let us look at another finance function, which is the PMT or the payment function in Excel. The PMT function is used to calculate the fixed periodic payment for a loan. This function is extremely useful in banking, project finance, and loan repayment analysis. So here we have a loan of $200,000. The time period to repay the loan is 20 years. Interest rate is 7%. We are required to calculate the EMI or fixed periodic payment for this loan. So before using the PMT function, let us understand the inputs required. So PMT function requires 5 inputs. The first 3 inputs are compulsory and last 2 inputs are optional. So rate is the interest rate on the loan. NPER is the total number of payments on the loan, which is total EMIs. PV is the present value of the loan. FV is future value, which is zero in most cases in case of loan repayment schedule. And type is again optional. So 1 means beginning of the period and 0 means end of the period. If the borrower wants to repay the EMIs at the beginning of the period, the input should be 1. If the EMIs are at the end of the period, he should enter 0. Now, to use the PMT function, we will type is equal to PMT, bracket open. The first input is the rate. So, these installments will be paid every month. So what we'll do is we'll select the rate and then divide it by 12, which is the monthly interest rate. The second input is NPER, which is total number of EMIs. So we'll select 20 and multiply it by 12 because the total EMIs will be 240, 12 EMIs every year. The third input is present value of the loan, which is 200,000. We can close the bracket and press enter. So the EMI for this loan is 1550.6. It is a negative because the EMI payment is a cash outflow for the borrower. If we put a negative sign over here, it becomes positive. Now, this formula assumes that the EMI is being paid at the end of the period. So, let's see what happens if we pay the EMI at the beginning of the period. So, the fourth input, which is future value, we can leave blank or enter 0, assuming that the full value of the loan will be repaid in 20 years. And for type, we will enter 1 if the EMIs are paid at the beginning of the period, and then enter. So we see that the EMI amount has reduced from 1550 to 1541 if it is paid at the beginning of the period. But the default value is 0, so we can change this one to 0 and press enter. So if the borrower pays the EMIs at the end of the period every month, so the EMI amount will be 1550.6. So this is how we can use the PMT function to calculate the loan EMIs.
Welcome back. In this video, we will discuss the rate and NPER functions in Excel. Both these functions are commonly used in finance to analyze loans, investments, and financial planning scenarios. Let's start with the rate function. The rate function helps us calculate the interest rate per period of a loan or an investment. In simple terms, if you know the loan amount, the payment amount, and the number of periods, Excel can help you determine the interest rate being charged. Let's first understand the syntax for the rate function. The rate function requires 5 inputs, out of which the first 3 inputs are compulsory and last 2 are optional. The first input is number of periods, which is the total number of payment periods. PMT or payment is the payment to be made in each period. The present value is the loan amount or the value today. And FV is future value, the remaining balance after the final payment, usually 0 for loans. And type indicates when the payments are made. 0 means payment at the end of the period, and 1 means payment at the beginning of the period. Let's look at a simple example. So here we have a loan amount of $200,000. The time period is 20 years. Loan EMI is $1,500. It is in negative because it is a cash outflow. And we will use this data point to calculate the interest rate. So to calculate the interest rate, we type is equal to rate, bracket open. The first input is NPER, which is number of payments. So the loan time or tenure is 20 years. So 20 years and the EMIs are monthly. So we'll multiply it by 12, comma, the payment is $1,500. So we'll link it to C6, comma, the present value of loan is $200,000, comma, and future value is in square brackets. So this is optional. So future value in case of loans is generally 0. So we'll enter 0 over here, close the bracket and enter. So it comes to 0.5%, which is the monthly rate. And if we multiply it by 12, we get the annual rate of interest for this loan amount, which is 6.6%. Now let's see how we can calculate the number of EMIs or number of payments. The NPER function calculates the number of periods required to repay a loan or reach a financial goal. The syntax is NPER, and then in brackets, you need to enter the rate, which is the interest rate per period. Payment is the amount paid each period. The present value is the loan or the investment amount. Future value is the desired ending balance. And type again indicates whether the payment happens at the beginning of the period or end of the period. So let's quickly understand how we can calculate the number of payments. So here we have the same data points. So the loan amount is $200,000. Interest rate is 7%, which is higher than the 6.6% we calculated here. And EMI amount is same, which is $1,500. To calculate the number of payments, we'll type is equal to N per bracket open. The first input is rate, so we'll link it to C12 and then divide it by 12 because we need the monthly rate, comma, PMT is $1,500, comma, the present value of the loan is $200,000, and then we can leave the FB, which is future value, and type as blank, or we can ignore those inputs because they are optional. Close the bracket and enter. So we get 259 EMIs for this loan, and if we divide it by 12, we get the number of years. So the number of years over here is 21.55. So to repay this loan, the borrower has to pay $1,500 every month for 21.5 years. Let me change the interest rate to 6.6%, which we got over here. So now the time has reduced to 20 years, which was one of the inputs in the rate calculation. So this is how we can calculate the rate and the number of payments required to repay a loan in Excel. Thank you.